Welcome to the Tech Today podcast. It's your host, John Maeda. We just published our QT and BTFP notes. I wanted to speak for a moment on the bank term funding program. So what's been happening, if you look at, here's our note, by the way. If you go down to the chart, expand that. So what's been going on for the past few weeks, that blue line that you see, that is the BTFP rate that the Fed charges banks to borrow from the Fed. So you can see it's been below 5% for the past few weeks. And if you recall, Fed funds has been above 5% for a period of time. It's at 5.33% today. And so what the banks have been doing is, as the bank term funding program borrowing rate has fallen below Fed funds, the banks are arbitraging. So they're borrowing less from the discount window and borrowing more from the bank term funding program, given that you have this rate discrepancy. So the Fed is contending that the BTFP has served its purpose, and that the Fed therefore is going to let the BTFP expire on March 11th, the one-year anniversary of the BTFP program. I'm not buying that. I don't buy that the banks are strong. I do believe that, if the Fed said they're going to allow the BTFP program to expire, I believe they will do so. But I believe that once the Fed allows the BTFP to expire, the banks are going to become more conservative. They are going to pull back on lending, because remember, the banks are still carrying very substantial unrealized losses on the debt securities that they bought when interest rates were at zero. And so because of those losses, the banks will be conservative, particularly in the absence of this BTFP. And so what does that mean? That means that the Fed is going to have to do something else, right? They're pulling the BTFP, they're pulling that crutch away from the banks. So the Fed is going to have to do something else to ease conditions for the banks. And I believe that will be to reduce the Fed funds rate. And I don't buy that the Fed is going to, the market sort of expects 3 rate cuts this year, 75 bips in total. I think the rate cuts are going to be far more aggressive than what the market expects. I just think the banks are going to pull back and be far more conservative. That's going to cause economic conditions to tighten substantially. That's going to exacerbate this recession that we're already in. And that economic pullback, that reaction, is what's going to cause the Fed to drop rates and drop them quickly. Right. So I think it gets very interesting in mid-March when the Fed allows this BTFP to expire. That's all for now. I'll see you next time.